In some US markets, commercial insurance costs for Uber can consume nearly half of each fare. When you open the Uber app, you see a price. You see a car arrive, but for the person behind the wheel, that price is not a paycheck. Is the start of a complex subtraction problem. For years, the narrative around ride-sharing was simple: be your own boss and earn a flexible income. But the reality of the gig economy, a labor market characterized by short-term contracts or freelance work, is often hidden in the gap between gross earnings and actual take-home pay. To understand the mechanism of an Uber driver's income, we have to look at the take rate. This is the percentage of the total fare that Uber keeps for itself. According to Uber's own communications, as of the third quarter of 2025, the company's global take of rider payments is 21%. This is the portion Uber uses to cover payment processing, background checks, marketing, and research and development. However, the biggest slice of that corporate revenue goes toward commercial insurance. In the United States, this cost is particularly acute. In Los Angeles, insurance costs can consume almost half of each fare. In New Jersey, it can account for nearly a third. But for the driver, the corporate take is only the first layer of loss. The real erosion of earnings happens through operational costs. The car is the driver's primary tool, and it is an expensive one. For those who don't own a vehicle, Uber offers rental services through partners like Hertz. These rentals can cost $240 or more per week. If a driver is paying $240 a week just for the right to use the car, that recurring cost eats heavily into their daily earnings. Let's look at a real-world example of how these numbers play out on the street. One driver tested the experience over 3 shifts, totaling roughly 10 hours of active driving. In that time, they completed 10 trips and covered 305 miles. Their total gross earnings were $143.73. On the surface, that looks like a decent side hustle. But then comes the subtraction. First, the fuel, $38.80 spent on 1 tank of gas. This brought the earnings down to $104.93. When you divide that by the 10 hours of work, the actual pay is $10.49 per hour. This is significantly lower than the $15 minimum wage in Maryland. There is also the issue of tips. While often touted as a way to boost income, the reality can be lean. In this specific test, only $3 of the total earnings came from tips. For many, the only way to reach the higher end of the suggested $15 to $25 per hour range is to treat the job as a main hustle rather than a side one. This requires embracing the people side of the business and being willing to roam far from home. The Uber algorithm matches riders with nearby drivers, and those who reject long trips or those that end too far from their home base often leave money on the table. For the high earners, those who treat this as a full-time profession, the strategy changes. Some disciplined drivers report earning between $1,500 in a typical week. But these drivers must maintain a slush fund, a reserve of cash specifically set aside for the inevitable costs of vehicle wear and tear, maintenance, and insurance. This tension between the corporate promise and the driver's reality has led to significant legal friction. In January 2017, Uber agreed to pay $20 million to the Federal Trade Commission to resolve allegations that the company had misled drivers about their potential earnings. The conflict stems from Uber's classification of drivers as independent contractors rather than employees. This means the driver, not the company, bears the brunt of the operational risks. Uber argues that its profitability is not coming at the expense of the driver. They point to the third quarter of 2025, where drivers and couriers on their platform took home a total of $22 billion. They claim that in the U.S., median driver earnings per utilized hour, including tips and incentives, are more than $30. They argue that while prices have risen, the share given to drivers has remained relatively flat because Uber passes increased booking fees, driven by rising insurance costs, onto the riders, not the drivers. But the history of the platform suggests a more aggressive approach to growth. Leaked documents known as the Uber files revealed a period between 2012 and 2017 where the company used a tool called Greyball. This software used geofencing and social media mining to identify and avoid law enforcement officers in cities where Uber was operating illegally. It was a strategy of seeking forgiveness rather than permission. Ultimately, the Uber economy is a game of margins. For the company, a few cents of profit per trip adds up to billions at scale. For the driver, the difference between a profitable week and a losing one often comes down to the price of a gallon of gas, the cost of a rental, and the willingness to drive 30 miles away from home for a $30 fare.